Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and in today's video, we're going to be taking a look at 3 stocks that I believe are trading at deep discounts right now. Now, if you guys do enjoy this type of content and appreciate the transparency, all I ask is that you subscribe to the channel. It would help me out a ton. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Now, with that being said, let's start by taking a look at my portfolio dashboard. So in total, I have invested $54,392. $19,561 were invested this year alone. Now, I want to just reiterate that I have been investing weekly into the portfolio. I've been buying $100 of VOO every single week and also 1 share of schd so far this year. Now, this is a new strategy I've been implementing, but regardless of price, I've been dollar cost averaging for the entire year, and at the end of the year or the beginning of next year, we'll reevaluate that strategy and decide what I'm doing for next year. So far, I am a pretty big fan of it. I like that it makes me continue investing every single week regardless of stock prices. Now, in terms of portfolio value, we're currently sitting at $74,273, and the stock market has been a little bit all over the place for the past couple of days because of the tariff announcements and potential conflicts with China. Now, overall, we did finish the week pretty green, so my unrealized gain is at almost $20,000, and my total return is about 36.55%. Now, since starting this portfolio, I have made over $2,000 in dividend income, and you can see the breakdown by year right here. I keep track of it every single year, and my yearly income going forward has broken the $1,000 mark. It's now almost $1,200, which would be almost $100 per month. Now, the reason that my yearly income is fairly low, even though my portfolio value has increased substantially since starting the channel, is because my portfolio yield is pretty low as well at 1.57% with a yield on cost of about 2.14%. Now, this is fine and is actually intentional. For my taxable brokerage account, which is what I track right here in these videos, I actually prefer a lower dividend yield. My big goal while investing right now is to maximize total return, and I just think that dividend paying stocks are a great way to get there. Now, I do want to clarify, I also have some non-dividend paying stocks like PayPal, Amazon, Intel, and Uber, and we'll get into some of those today. So without further delay, the first company that I think is trading at a pretty steep discount right now is Adobe, ticker symbol ADBE. Now, I do want to clarify that for the 3 companies that we're going to be talking about today, none of them pay a dividend. So if that's something that you're really interested in and want to see a video next week focusing on 3 deeply discounted dividend paying stocks, let me know in the comments down below and I'll be happy to get to it. So Adobe is down substantially year to date, and this is a 10-year graph. You can see that it peaked pretty early on in like 2020, 2021, and then since then it's had a hard time keeping the stock price up. Now, if we hop into Google Finance, we can get a better idea of the stock's performance. So year to date, it's actually down 24.43%, which makes it a pretty poor performing company within the S&P 500. In the past year, it's down over 32%, and in the past 5 years, it's down 33.7%, so not a great sign at all for investors who have been holding onto the stock for any of these past couple of years. Now, there were some pretty great opportunities to buy the company. When it did bottom out in 2022, you can see that there was a pretty big rally after that where it more than doubled, but since then the stock price is almost flat. It's up 21%, which is not bad, but definitely not what you're looking for in a growth company like this. Now, of course, in terms of all-time performance, it is one of the best performing companies in the stock market. It has a great history full of tons of revenue growth, and we'll see how that shapes up in the future. As of right now, the company does trade at a price to earnings ratio of about 20.77, but keep in mind that they do a lot of dilution through stock-based compensation. So in my opinion, price to earnings ratio alone is not the best indicator of whether or not the valuation of the company is good right now. Hopping back into the financial graphs, the main reason that Adobe is dropping so aggressively is because of the AI fears surrounding it. It's not the only company in the space having some problems. CRM, Salesforce, which is also a tech company that sells software as a service, is also seen a pretty big decline in their stock price for the same exact reasons. Now, the reason I'm highlighting Adobe over Salesforce in this video is because I believe Adobe's revenue growth is going to be more resilient than Salesforce. They've had a pretty big contraction, Salesforce, in the past couple years from how fast the revenue growth was growing before to how slow it's growing right now, but Adobe has so far been able to keep it up. Now, just to be transparent, I don't currently own any shares of Adobe, and it's not because I don't think it's a good buy right now, it's because I already have too many holdings and I'm trying to narrow down my portfolio. Regardless, I think this could potentially be a great opportunity to start building a position in Adobe at these lower stock prices, and it might have a further drawdown, but we'll have to see where it goes. In terms of financial metrics alone, there's not much that scares me from the company, so revenue per share has been growing quickly over time, and based on guidance from management is expected to continue growing pretty aggressively in the future. Now, of course, if that doesn't shape up and revenue or earnings per share or free cash flow per share start to come down and start to slow down in growth, then that will be justified as to why the stock price is coming down so aggressively. However, if the company is able to keep growth in the double digit range, right now it's growing over 10% a year usually. If they're able to keep doing that for the next couple of years, there's no doubt in my mind that the company will re-rate to a much higher valuation and much more close to fair value. In terms of earnings per share, it's been growing quickly with a bit of a peak here in 2020, and the free cash flow per share has been growing aggressively over the past 10 years. Now, the company does a lot of stock-based compensation, so from a financial standpoint, this is the most concerning thing about the company. You can see how big of a portion of free cash flow it makes, so you have to discount that when taking any sort of valuations on the company. It also doesn't look like stock-based compensation is slowing down too much anytime soon, so I would not bet on that. Regardless, the company has been aggressively buying back shares, so their shares outstanding have gone down significantly over time. They will be going down even faster, close to 10% per year, if they weren't diluting so many shares using stock-based compensation. Now, for net income margin, it's a software-based company and they're not doing too much research and development right now. Their products are pretty sustainable as is, so their net income margin, as expected, is very high. Their capex is pretty low, which makes sense as well, and their return on invested capital is also pretty high, close to 30%. So the main concern with Adobe, of course, is whether AI is going to eat at its moat, and I think the answer is yes. It will pose an actual threat to Adobe as well as companies like Figma and Canva. Now, that being said, Adobe is slowly developing its own set of AI tools and incorporating AI into their existing product line, so that might have a bit of a chance to help the company out in the long run. Overall, I think the company can continue growing earnings pretty quickly over the next 5 to 10 years, and I believe that if they execute on that and that AI does not take their entire moat away, I think the company's stock price will increase substantially from here. Now, the next company I want to highlight is Fiserv, ticker symbol FI, and you can see right here in the past 10 years, the company was growing extremely well, and then in the past year-to-date period, basically, the stock price has absolutely crashed. Now again, to get a better look, let's hop into Google Finance. So year to date, the company is down 41%, which is absurd. And in the past year, the company is down almost 40%. You can see that most of the drop came right here. So from March of 2025 all the way till now, it's down 48%. Now in the past 5 years, the company is still trading positive. If we measure all the way to the peak, it was up 132% at one point, so over a double, but now it's trading only up 20%. In terms of max performance, this company has been around for a long time and has performed extremely well. If we measured it from the peak, it would actually be even better than this. At the peak, it was up over 82,000%. Now, the reason I bring this up is to show you guys these companies are not necessarily new. This company has been around for a while and has had a pretty good track record for most of its history. Now, the price to earnings ratio trades similarly to Adobe at 20.33, but I believe that they have lower levels of stock-based compensation. Hopping back into the financial metrics, the revenue per share has been growing extremely quickly over time. The earnings per share have been a little bit bumpy here in 2019 and 2020, but have overall been growing pretty fast. And the free cash flow per share has been steady and increasing quickly, which I like to see. Now, in terms of stock-based compensation, you can see that it is substantial, but it's a much smaller percentage of free cash flow compared to a company like Adobe, which is something that makes me feel a lot better about investing in this type of company. Now, the shares outstanding were dropping quickly, but because of an acquisition, they did jump up a lot in 2020, but since then they've continued to buy back their shares aggressively. Now, while we're on the topic of share buybacks, one of my main thesis with this company, Adobe, and the next company we're going to take a look at is the amount of shares they're buying back currently. In my opinion, management sees this as an opportunity to buy back discounted shares, and they're taking full advantage of it, aiming for about 7 to 10% per year for a lot of these names. Currently, Fiserv's management is buying as much of their market cap back as they can, so in the long run, this is going to help increase those per share metrics like revenue, earnings, and free cash flow per share. Now, the company did used to pay a dividend and they stopped in 2017. So if you're a big dividend investor and refuse to invest into any companies that don't pay a dividend, I completely understand. But if you're open to investing in non-dividend paying companies, this could be a great opportunity. The good thing about them not paying a dividend currently is that while their stock price is low, they're able to take full advantage and put all their free cash flow into share buybacks instead. I think in the long run, that'll have a better effect on performance than doing dividends at this time. Once the company matures and is stable once again, it would be nice to see them start a dividend, but in the meantime, I'm okay to wait. Now, they are a fintech company, not exactly in the same space as Visa and MasterCard, but they do compete on some fronts, especially when related to debit purchases. But their net income margin, because that is pretty high at 15%, and their capex has been increasing over the past couple years, but overall, it's not that big compared to the amount of free cash flow they're generating. Now, Fiserv does own the company Clover, and those are some of those payment processors that you might see when you go to a cafe, kind of like Square, same idea as that. Their return on invested capital is actually a little bit low for my liking. It's close to 10%, but not quite there. I'd be much happier if we were seeing it over here in these 2017 levels, but I think they have had a little bit of a hard time right now with their profit margins. Now going back up to the top, the main reason for this big decline in stock price is the revised guidance, but I think it's way overblown currently. Now there might be something that big investors are seeing that I'm not seeing, but in the numbers it's currently not showing. Now if the revised guidance wasn't enough and they revised guidance even lower once again, this might be a little bit trickier of a situation, but even then the company's trading with a pretty big margin of safety in my opinion. Now I don't currently own this stock for the same reason as Adobe, but if I had one less position, for example, if I didn't own Visa, MasterCard, or PayPal, I would definitely be opening up a position in Fiserv. Regardless, I'm going to keep this company on my watch list. It's getting very tempting, especially if the stock price drops even further, so I might start a position if that does happen. Now the last company I want to feature in today's video is a pretty controversial one, and it's PayPal, ticker symbol PYPL. Now if you guys have made it this far into the video and are enjoying it so far, leave a like, it will really help out the channel. So out of all three companies, PayPal is actually one which I do own in my personal portfolio. I own about a 2.5% position, I believe, in it, and we'll take a look at my own position in just a couple minutes. But you can see right here how crazy the volatility has been in this stock. Now this peak right here was when PayPal was trading at just unreasonable valuations, basically astronomical during the last bull market, and since then it's come back down to what I would consider a very reasonable valuation. I think the company is still getting punished because investors don't want to hop back in over fears from how bad it was last time, but I think at current valuations it's a completely different story. Hopping first into Google Finance, we can see the year-to-date stock price performance. Now all these companies are very close to their 52-week lows. PayPal's a little bit above that, but the other two companies are basically at their 52-week low. In the year-to-date period, it's down almost 22%. In the past year, it's down 16.72%. Now, the one thing I want to highlight here is I bought the company, I believe, 1 or 2 years ago, and the stock price was actually able to hit a high of over $90 per share. I believe my cost basis at the time was about $60 to $65 per share, and so it was performing very well for a bit of time there. Since then, of course, the drop has been pretty aggressive, and we're now down over 25% from the peak. Now, in the past 5 years, the company has been a terrible investment, but something to keep in mind is that right here, it was trading at unreasonable valuations, which I don't believe it's trading anywhere near that today. Basically, buying the company now is not taking the same kind of risk that investors were taking over here. It made no sense buying in 2021. I did not own a position back then, but since then, I think it's come down to what I would consider to be a more reasonable price point. It currently trades at a price to earnings ratio of 14.43, but as we'll see in a second, it does have a bit of stock-based compensation. In terms of revenue per share, it's been increasing nicely over time, but the earnings per share have been a little bit more sporadic, with 2020 and 2021 peaking, and then 2023 and 2024 showing signs of growth once again. Now their free cash flow per share has been growing over time. They do generate a pretty large amount of free cash flow, which they have been putting directly into share buybacks because they do not pay a dividend, as you can see right here. Now, as I explained with Fiserv just a couple of minutes ago, I actually prefer this. If there's no dividend payout right now, that means that management can focus all their free cash flow back into share buybacks, which I think will have a better impact on total return in the long run. Now, if we take a look at their revenue, not on a per share metric, the company has had a bit of a harder time growing it as quickly in the past couple of years. So if the company does begin to slow down again in terms of their revenue growth, I think starting a dividend payout would not be the worst idea. Now, they are paying out a substantial portion in stock-based compensation. It's been a bit all over the place for the past couple years, but overall we can see that it is seeming to trend down in 2024, and I hope the same pattern continues in 2025. They recently brought in a new CEO, and his main goals right now are to both increase profitability, which would mean reduce stuff like stock-based compensation, of course, and increase margins. And he also wants to re-accelerate revenue growth, which is what we're all hoping for as investors. Now, the shares outstanding are going down between 6 and 7% per year, and I don't think we've seen the impact of it in the numbers too much just yet, but if they continue to do this within a year or two, I definitely believe there could be a correction in the stock price. We saw the initial signs of a rally as it approached that $90 per share mark right here, but since then it's fizzled out and died down just a bit. Now, their net income margin is close to 15%. This is nowhere near Visa and MasterCard levels of profitability, but it is getting better, and they have a little bit more competition, I'd say, than Visa and MasterCard, and that's one of the main fears that's pushing the stock price down. With large competitors like Stripe getting even larger and new startups, it's been putting a lot of downward pressure on the stock price. Investors are kind of selling out of fear. Now, in terms of CapEx, it has been pretty steady. There's not too much that they need to invest into right now, and the return on invested capital is decent. It's about 13% right now, which is not too bad at all. Now, I do believe that PayPal's stock price has been depressed for quite some time, and I think that at the beginning it was justified. This peak right here and then sell-off was a big problem, and I know why investors did not want to hop back into the company. Since then, I think the company has began to prove itself once again and has started to re-accelerate growth as well as continue to invest in their share buybacks, which I think long-term will provide some pretty good returns for shareholders. We'll take a look at my position in a second, but just to be transparent and upfront, I'm definitely going to continue holding onto my position for the foreseeable future. I'll let you guys know if anything changes. And if the stock price continues to stay low or dip down, I'll probably be adding more into my position. I've been really tempted over the past month to add more into my PayPal position. I don't think it's going to have astronomical growth, but I do think it's a pretty easy double within the next 5 years. Now, so far, I've resisted adding more shares because I already do own a pretty full position in the company, but if the stock price remains flat or even comes down, I'll probably be adding anyways because, like I said, I think it's a pretty easy double for me within the next 5 years. Now, before we wrap up the video, let's take a look at my own individual holding in the company. So my average price paid or my cost basis is $64.21 per share, and the current price is $67.41. And the reason it's highlighted red is because the current price is pretty close to my average price paid. In total, I purchased 33 shares, the same amount for DRIP because there's no dividend reinvestment happening, and my amount invested was about $2,100 with a current value of about $2,200 or a 5% total return, which is pretty low. Now, at some point, this was one of the better performing companies within my portfolio, but since then it's come down a lot since the stock price has come down aggressively. Now, not much to see in terms of dividends, of course, or yield, but in terms of allocation, it's currently 3% of my portfolio value, which I consider to be a full position, but I might make it a larger position, maybe 5 or 6% of my portfolio value for the time being, since I believe it's trading at a discount and I want to continue holding this company. Let me know down below what your thoughts are on PayPal and if you think it's a value trap or a value investment. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at 3 companies which I consider to be trading at a steep discount. Now, if you did make it all the way to the end of the video, let me know down below which of those 3 companies is your favorite and if you're buying any of them right now. Now, if there are any other stocks that you're buying right now that you believe are trading at a discount, let me know in the comments down below as well. Now, this video was focused on non-dividend paying stocks. If you do want to see a video focusing on dividend paying stocks that are near their 52-week low or trading at a steep discount, let me know and I can do a video on that next week. If you haven't yet watched my last video where I talk about my dividend income for the month of September, check out this video right here. And if you want to see my favorite bet on real estate right now, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.